Hi, everybody. Welcome to the webinar. It's 1 o'clock. We just see a bunch of people joining right now, so we're just going to give it a few more seconds to make sure we get the most people so they don't have to hear anything, just not starting out too late. So give us just a few more seconds. Okay, it's 1:01. We're going to get started because we know everyone's time is limited. My name is Leslie Benjamin. I'm with Strategic Compliance Partners. I'm happy to present Ari Karen, who's Strategic Compliance's CEO, as well as a partner in the Arthur Kerman law firm. Ari is going to present today the ins and outs of loan officer compensation agreements. For those of you who don't know Ari, he's a principal in the Arthur Kerman law firm in the Financial Institutions Regulatory Practice Group, as well as the Labor and Employment Practice Groups. He's the founder of SEP as well. So right now, I'm going to hand it over to Ari as he goes into the topic.
Thank you, Leslie. So we're going to do this today. I want to talk about kind of a couple things, what we're going to focus on. First, I'm definitely going to talk about employment agreements and LO comp agreements, but I also want to talk about brokering because I found that there's a huge confusion amongst lenders and brokers about certain rules that obviously are critical to creating these agreements, right? Because if the substance is wrong, then the agreement's kind of wrong. And I've been getting a lot of feedback that there's been a great deal of misunderstanding around that. And these rules really are confusing in many respects. Paying a loan officer who, when from a correspondent, not when you're dealing with sort of the rules around brokering compensation is in many ways much easier. It's very confusing on the brokering side, and I want to try to clear a little bit that up while we're going through this, because I have seen a great deal of really common and pretty severe non-compliance in those issues. And I don't say that from a moral, like you guys are bad perspective, right? I'm saying it from a people truly don't understand. And unfortunately, I found there are people out there giving some really inaccurate information. Again, I'm not saying intentionally, just it's happening. And I think people are being kind of misled a little bit unwittingly. And then we're going to go through kind of what the purposes of agreements are. And I think that's really important when you write up an agreement to understand why you're writing it. If you think about it, if everything goes great, everyone understands everything, there's no disputes, you actually never look at that agreement again, right? Person works for you for 5 years, everything's happy, they leave on good terms, and everybody's happy, and the world goes on, and, pixies and fairy dust and all the kind of good stuff happens, right? Cinnamon and sugar and all those things, nice. But so you're not writing it for that situation. You're writing it for the other side. And maybe it's not a full-fledged dispute, right? But there's a disagreement. There's something that people don't understand. And to avoid the disputes, right? When I tell you something and you hear it a different way, like that's why putting in writing is so important, because you can't hear something wrong. So you're really trying to create an agreement that's going to avoid disputes and win those disputes without them going further. But that's when the insurance policy, I call it, sort of kicks in. And what I mean by that is if all else fails, right, you've written it, they don't understand it, there's a dispute, something wasn't put in there, writing the agreement like an insurance policy is simply to protect you from someone who's trying something, right? Maybe it's an employee who left and took a lot of business and you have to go after them for it and because they did things wrong, and then they raise the agreement and say, but this and this and this was wrong. So sometimes it's not always on the most legitimate reasons. It's sort of constructed as an issue. And that's really where the last piece of this is writing these for litigation, which is the ultimate judge, right? I mean, the ultimate judge is a judge. And what I mean by that is, like, when you write these agreements, you have to think about, and this is what I do because, again, my background as a litigator, is writing them in a way that if you go to court and a judge reads them, what are they going to do? I'll give you a quick example, okay? And this isn't really covered, but it's one of the things that I see a lot of times. So I have lenders who give me agreements that have been, I hate to say this, but kind of cobbled together from a lot of other agreements from a lot of different attorneys and sources over the years. And they're 10 pages long, and they've got policies in there and just all kinds of stuff. And, I invariably tell them, take all the policy stuff out, put it in the policy guide. And the reason I say that is because, when you have the experience of having been in front of a judge with an employment agreement, and the judge looks down often from his or her glasses while you're arguing, maybe reading this contract for the first time, in open court, and they can't find the page because there's 10 pages and it's all double-spaced font, and they kind of just get impatient, and then, you're already down, whereas you could say, page 2, section 3, letter A, boom, easy. That's what you're looking for. You want something that's easy to get through. So take out sort of that superfluous information that you don't need. Make sure anytime you're writing an agreement, there aren't redundancies or inconsistencies. And I sort of see those, by the way, as two sides of the same coin, or maybe even the same side of the same coin. Because if you say something right in an agreement when you're drafting it, say it once and don't say it again. Because invariably, if you say it again and you say it a little bit differently, when you're in that scenario of someone who's trying to construct a dispute, that's their opening, right? Well, you said it like this, that way, and that's what I thought you meant. But then you said it, and now I'm completely and totally confused. I don't know what it means, right? And then you're kind of off and down that path. But if you say it once, you say it right, it's clean, not a lot of room to do that. So anytime you see those contracts that go 7 and 8 pages and they got a lot of stuff in them, I'm always sort of like a flag, like you should be able to do an agreement in 5 or fewer pages, definitely, usually 3-ish, 3, 4, in that range. Anything over that, you're starting to get in those areas of like, well, what's in here we don't really need? Again, it's a general rule. I'm not saying that if you may have a 10-page agreement that's perfectly great for what you're doing, right? So this is a general rule. But most agreements should kind of be in that 3 to 5 page area. Again, general rule. So I want to kind of think about that, though, as we go through these agreements and what we're thinking. You have to really keep that purpose in mind as you draft them. What is it you're trying to achieve? And if it is that sort of that ultimate judge is the judge kind of concept, think about how you're drafting. A lot of times I see agreements written up by people who are industry people, and they write using industry jargon, something that I know that the manager or the owner and the loan officer fully understand what that means. But even as a lawyer who represents the industry, sometimes I'm confused a little bit about, right? And, if you're using that kind of jargon or kind of even sometimes internal company jargon without defining it, how's the judge going to follow it? They're not. If they don't follow it, you're the employer, pretty much you lose. No matter how clear it was to everybody else in the room, if they don't understand and you're the employer, pretty much you lose. So think about that also drafting, those sort of internal jargon, the shorthand that people often write on, not in agreements. You got to spell it out. Okay, so think about those as kind of general drafting concepts. Now let's go to obviously the actual substance of the rules in brokering. Now, I call this 101, sort of your foundational, this is kind of how it works, right? Here's the concept. You can't steer, when you're brokering a loan, you can't steer a borrower to a less advantageous loan to enrich yourself. Simple concept, sounds pretty easy. Now, to facilitate that rule, okay, what they've said is that it's okay with compensation if you do one of two things. If you have the lowest cost loan, in other words, the lowest cost loan, what I mean by that, and it's probably not written perfectly well, speaking of contracts, the lowest cost to the borrower and also the lowest compensation to yourself. So if you have that lowest sort of, you've made the least amount of money on the loan, obviously they assume you haven't done it to enrich yourself because you've made the least money. So when you have a loan that is the lowest amount of compensation really to you, you're okay. That sort of establishes that you did a good job. And I realize there's a disconnect there. Just because you made the least doesn't mean it was the best, but there's clearly no steering if you put yourself in the least expensive loan. Okay, so that's one. Number 2, this is the other one. If you can establish it was the best deal. Now here's the thing. You could have steered yourself to the highest possible compensation, made more than anything else, and if you can show that that was the best deal for the borrower, it's fine too. So it's an either or. Either you get the least amount of compensation, which you don't really need to show anything after that, just I made the least, then you didn't steer, or you have to establish it's the best deal. Now, here's the thing. They created a safe harbor, if you kind of follow in my flow chart here. where they said, look, if you give this disclosure, and that disclosure, I call it the Holy Trinity. You've probably seen this. It's the loan with the lowest cost, the loan with the lowest rate, and the loan with the lowest rate without certain types of terms like certain types of terms in the loan, such as variations of interest rate and prepayment penalties and things of that nature, right? So without those sort of features, and if you give that, I call that Holy Trinity disclosure to a borrower, and then you're pretty much fine. But to create that one correctly, you have to look at you have to base it on a substantial number of loans from all available lenders. And the key is, again, the consumer doesn't have to pick one of those. They just have to be given that disclosure. And if you do and you give it, then you've sort of got a safe harbor, which establishes kind of those first 2 points, either the best deal, so to speak. It's a safe harbor for that. So I'm going to go through and dissect this a little bit more so we understand what we're talking about. I also wanted to pull this straight out of the commentary. I'm not saying these are all quotes. I've shortened some of them just for the purposes of this presentation and tried to stay in English, but I do want to take people through these so they understand it because it gets really confusing. Here it says, you can't direct or steer a consumer to increase compensation compared to other transactions unless it's in the consumer's best interest. So it's okay to steer them to higher compensation if the deal is also in the consumer's best interest. So yeah, I made more, you got the best deal, everybody's happy. That's fine. You don't have to accept or take them to the lowest comp. You just can't be in a scenario where they're put in a worse situation to enrich you. That's the key here, okay? Now, how do you establish the consumer's best interest? Well, then you would have to look at, and this is where it's really going to get confusing. To establish the consumer's best interest, you have to compare it to all possible loan offers available from the originator for which they're willing to qualify. Let's break down what that means. Now, there's a whole definition of all available, and it's pages, like it's literally pages long. The concept is, though, the real important point, you can't determine what's available. What's available, there's a specific statutory basis. It goes along the lines of anybody you've done a loan, if you've done a loan with them in the last 12 months, and I could send you guys the specific, there's a whole bunch of delineations, but the bottom line is this. I mean, without all of these, detailed statutory text in here, if it's an available lender and somebody you could get the loan from, right, it doesn't mean you've done a lot of business with them. They could have done a loan with them 6 months ago, but they're available. They're an available lender for you in the general sense of the word, okay? And again, if you want to parse through the statutory text, you can, but at the end of the day, this is pretty much what it means. Available means available. It means, is that somebody you could do the loan through, right? That's the gist of it. And if the reality is yes, because you have a business relationship with them, then that is one of the available offers you would have to establish, right, and have to go through. So you would really have to say, is this the best loan that I could have gotten, really without going and forming a new relationship with a new lender, okay? So the answer is, if it is, then it is, okay? If it's not, then it's not. And that's sort of the consumer's best interest test. That's a hard test potentially, right? And a lot of times it won't be satisfied unless you are getting the lowest cost loan. Now, again, I wanted to point this out. You don't have to direct the consumer to that lowest compensation, okay, for you. But if you do, there's no steering. And again, the point is, if you direct them to something that isn't in the lowest compensation for you, then you have to go through this best loan test using all available lenders. So this is where we are, and kind of stop your analysis right now, because assume this is what you have to do. Really what would happen most times is you just get the lowest compensation, because it would be hard if you had a bunch of lenders to go through all of the available lenders that they could have qualified for and determine which loan was best for them. But now comes in the safe harbor. So if you do this, that exercise, if you meet the safe harbor, that exercise is now sort of potentially eliminated, right? Because all you have to do, sort of this safe harbor trumps the other pieces to it. If you do the safe harbor, you are considered to have complied with the other steps. So you don't have to go through those other steps if you have the safe harbor. That's why it gets really confusing, because the safe harbor, in many respects, isn't consistent with what the actual law is, which is why so many people get confused. And that's why I'm taking you through this so deliberately. That kind of avoids the whole consumer's best interest inquiry. It also kind of avoids the inquiry, what was the lowest cost, although that would be, or lowest compensation, that would be the pretty easy to show. But this kind of satisfies everything. So again, lowest overall, you have to present what I call the holy trinity: lowest overall dollar cost, lowest rate without certain features, and the lowest rate. And here's where it gets really interesting. You can present, all you have to do is you have to present 3 options for the borrower, okay? In this, you don't even have to present 3 options if one loan satisfies more of them. But what you have to do is you have to look at 3 options for the borrower. That is what is considered a substantial number of creditors with whom the originator regularly does business. So that's 3 or more. Now here, why am I making this point out? Let's say you have 50 possible lenders who could do this loan. They're not expecting you to look at all 50 lenders, although, to meet your safe harbor, okay? Although, if you didn't meet the safe harbor, then you would have to go through that exercise, right? You'd have to go through every available lender and say, was this the best deal? But if you meet the safe harbor, you don't need to do that. All you have to do is select 3. And there's really no rules about which 3 you select. So let's say you had 50 lenders and you had them at different comp points, okay? And you selected 3 of those who were not the lowest comp. In theory, you still meet this test because all you had to do was select 3 or more of them and give them those options. You didn't have to go through all 55 of them. So in a way, this is where the confusion leads in, okay? The safe harbor, in many respects, allows you to do that which you really can't do without meeting the safe harbor. This is why people get so confused about it. So I think you've followed that now, what can happen, okay? So as long as you look at 3 lenders, or not 3 lenders, sorry, as long as you have 3 scenarios, you look at 3 scenarios, and of those 3 scenarios are 3, potential sources to get the business, substantial number of creditors is 3 or more. So as long as you look at 3 creditors, lenders, and you ultimately provide a disclosure that meets the safe harbor test, that holy trinity, which doesn't even need to be 3 separate loans if one of the loans does all of them, then you have met your safe harbor and then you've complied with the rule. Also important to know, the borrower doesn't have to accept one of those 3. But if the borrower said, hey, I need a loan done in, 10 days max, 2 weeks max. I need somebody who can get this thing done. And the loans that you're working with, their turn times are, 30 days. Can't get it done in time. Could the borrower go off? Yes. They could go and take another option in that case. Now, if it happens all the time, that might be a flag to a regulator. So you'd want to make sure you document it. I would document that very, very carefully to make sure why you're not following taking one of those. Otherwise, you could see where you could get yourself in some trouble there. So so that's sort of the rule with giving, using it. Now, using the disclosure to broker loans. So let's switch to another area where there's a lot of confusion, which is around borrower paid compensation, okay? So here is the deal, and I'm giving you, again, right out of the final rule, and I'm going to highlight the pieces for it. It says, I'm violating one of my first rules of a webinar, which is to not read from my PowerPoint, but I think it's important here. So it says compensation paid by the loan originator organization, the company, to individuals, loan originators, is not prohibited simply because it is based on the amount of comp paid directly by the consumer to the organization. But the compensation to individual loan originator may not be based on any other term of the transaction or a proxy for it. This is why this is so important. So you switch to borrower paid and you have a rule that says you get 50% of what the borrower paid comp is. Is that piece on its face right there okay? Answer is yes. Here's the problem, though. Take it one more step. What if the only time you switch to borrower paid is when you have to give a lower interest rate than what otherwise you could offer? So every single time you go to borrower paid, I mean, you look at the last 75 loans you've done, every time you look at those loans and you compare them loans that are not borrower paid, and the loans with borrower paid are consistently at a lower interest rate compared to the same loans that were not borrower paid. So a correlation exists between borrower paid and lower rates. Can you do it? No. So why is that? Because then if there is a correlation, it's a proxy, right? The rules for being a proxy are twofold. There's 2 points to it, I should say. First, it has to be something the loan officer could steer, right? Be able to switch you from one thing to the other thing, which clearly a loan officer can simply not even tell you about the option of borrower paid, correct? I mean, they just never mention it, or they could, right? And if they do, and the result is that you get a lower interest rate more often than not, so a correlation exists, which is the second prong of the proxy test. If you could steer and there's a correlation between some factor and a term of the loan, which clearly is interest rates, then you can't do it. So here's the thing with the borrower paid compensation. There's simply no way. I understand what a lot of people argue. They say, well, it specifically says you can pay based on the borrower comp. It does. It does say, but that borrower comp can't be a proxy per the highlighted language I just read you, can't be a proxy for loan terms. And if a correlation exists, that's going to be a proxy because we know the loan officer can steer. The other thing is that you have to be careful is it a UDAP, an unfair deceptive act of practice. If I were to say, well, I only tell some people about the possibility of getting a lower interest rate and borrower paid, doesn't that unfair deceptive act of practice? I think it would be, right? Because what you're saying is I am omitting from all the customers that I don't do borrower paid. And when they ask me, well, that rate's too, can we get a lower rate? And I say no, that's really a lie. You could, you just have to do borrower paid. I'd make less as a loan officer, but hey, that's an unfair deceptive act of practice if you don't disclose it, or if you disclose it only to some people, then you get into fair lending as well, by the way. But point being, there's a lot of problems around this, and I see a lot of people saying, oh, well, if we switch to borrower paid, it's fine. I'm sorry, it's, I hate to be the harbinger of bad news, but look what it says, right? There's just no way to read it around that. So, again, I kind of covered the slide, I think, but I want to make one other point clear. The problem is not paying based on what the consumer is paying as borrower paid. The problem is if it's used for a proxy. So, can you do borrower paid and pay the loan officer based on what the borrower paid comp is? The answer is clearly yes, if it's not a proxy. As long as it's not a proxy, because it's kind of a separate inquiry, right? So it doesn't end there. That's the beginning of the inquiry. So let's kind of go through a couple of quick examples just to go through this, because I get pushback on this all the time, and I want to make sure it's clear, because I got a lot of people have kind of given one set of the analysis to lenders, and so lenders are under one kind of thought process. That's, again, why I gave so much detail in these slides. I'm pulling it right out of the legislative text so you can read it for yourself. Not these examples, of course, but let's take a look at them. So broker routinely competes with Wells of America, tells its originators that when they're in the pricing war, go to borrower paid so they can offer lower rates. That's a proxy, right? Can't do it. And I'm sure it's being used this way a lot. You just can't do that. There's no way, as you saw before, you can read that text and say it's okay. When could it be used? That's the other question I got. Well, when could we use it? I mean, obviously, let's talk about two where I think would be permissible. So the LO offers a borrower, you've got a loan officer who makes a certain amount and on every loan, and for whatever reason, the only loan that this borrower qualifies for is a loan that pays them, pays the company not enough money to compensate the loan officer. right? So loan officer, makes 150 basis points or 100 basis points, okay? And they pick a rate, or not a rate, but a loan that has 150 because that's the only one the borrower for that happens to be is going to qualify for, credit score, whatever it is. Now the lender is saying, hey, I can't make any money. 50 bips isn't enough given the processing fee and everything, all the other stuff. What do I do? So actually the broker in that case. So what you could do is you could say, okay, well, borrower, you've got to pay, we're going to switch to borrower paid, and it's going to be 300 basis points. Could you do that? Yes, and obviously we've got to worry about the QM test, so don't worry about it from that perspective if anybody's jumping on that. These are just useful numbers for making a point on the LO comp, not with respect to QM, ATR rules. But I think so in that case, you'd be able to kind of almost artificially increase the money you bring in to meet the compensation needs. Now that obviously wouldn't help you in a pricing war, right? Because you'd just be upfronting pricing as opposed to putting it down the road. So it can't really be helped in a pricing war, but that's kind of a scenario where you could use it if for some reason, you had to increase the price to make it up for the loan officer. And then example 3, this is another one. What if you have all of the loan, this originator just all they're doing is loans that are brokered? You could pay them just on the amount on every single loan, no matter what the loan amount was, right? No matter what you could pay it based on borrower paid. So hey, you never get any lender paid comp. You never do loans that involve lender paid comp. You're getting all borrower paid comp, and that's the way it's always going to be. There's really not a proxy issue then, right? Because there's nothing to compare it to. There's no steering possible because it's always going to be borrower paid. So that would be permissible as well. Now, can you pay loan officers based on the amount of the borrower? So you could do that, but again, it can't be a proxy for loan terms. Okay, so now let's switch to paying via 1099. I've been getting a lot of questions about this, which I thought had been sort of resolved a while ago, but again, there's some advice coming out there from some people that is saying you can do this. Okay, there is absolutely no way. Impossible. Okay, first of all, FHA explicitly doesn't even allow it, so I don't know what you're going to do on those loans, right? But that's just not allowed. It's don't pass go, don't collect 200, right? No, you can't do it. Let's just say you get past that because you're never doing FHA loans. I don't know why, but you don't. Okay. How about RESPA Section 8? Well, here's the thing. If you remember that case with the title company a couple of years ago, where the CFPB went after a title company and said, by the way, you can't pay this under RESPA. This was a RESPA violation because these title agents really were contractors. They weren't employees when you used the independent contractor test. The title agents were truly not employees. And so since they were contractors, it was a violation of RESPA to pay them. Now, hold on a second, right? What they've just said there, forget the whole employee contractor thing. What's more important? It's a violation of RESPA pay independent contractors, right, for referrals of activities. And under RESPA, remember, there's an exception. You can pay referral fees to your employees. That's why a bank teller employee can get $100 if they refer somebody for a mortgage, right? Because they're an employee. That's an exception to the rule. You can pay employees referral fees. But if they're a 1099 contractor, they're not an employee. And I know some people say, oh, well, it's just a tax designation. It's a pretty critical one. Right? I mean, it's like they either are, it's kind of like being, we used to say it's kind of like being pregnant. You are or you aren't. There's no half in between, like you're sort of pregnant. You're either pregnant or you're not pregnant. You're either an employee or you're not an employee. If you're taking advantage of the tax rules to say you're not an employee and you're not paying a payroll tax for them, you don't get then on the regulatory side of banks saying, but for this purpose, they are employees. You should just treat it the same. Like you don't get to have your cake and eat it too, right? So how are you going to get past RESPA when you pay your LO, when you pay your loan officer for originating loans? And I have some people have made the argument, and I've seen it in writing, which is kind of startling to me, but people have made the argument, well, it's no different than when a lender pays a broker organization. Yeah, it is, because they're not a broker organization. Like they're not, right? Even if they're 1099, especially, by the way, if it's coming from a broker, because a lot of times brokers are the ones who are most confused about that, like get the least advice on this area. Because again, I think sometimes people are targeting that area with not the best advice all the times. But if you're a broker, then you're not even a lender, right? I mean, for example, if you say, well, lenders can do it, but you're not a lender, you're a broker. That's a huge distinction, right? So you just can't do it. But here's the other thing, even if you wanted to try to argue past that, is the fact that when you ask about a 1099, that says essentially what a 1099 is somebody who acts independently. They use their own methodology for doing things. They use their own discretion and judgment on how to do things. They do things on their own, and the only thing you can be really hold them responsible for is the final product of the work. So think about it this way. You hire someone to put in a new kitchen for you. You don't get to tell them the order of the kitchen and which kind of tool to use when they're taking out the cabinet and, they're using a socket wrench or a drill. Like, you don't get to do that. You basically get there at the end and say it either looks good or doesn't look good, and according to what we agreed or not, right? That's what it's measured at, right? But you don't control how they did it, who they hired, when they did. You don't control any of that. Here's the thing. That's totally inconsistent with the SAFE Act. Under the SAFE Act, you take on certain accountability, and you're supposed to be responsible for exactly those things, the method and manner in which they do this, right? That's what you're responsible for. So if you're saying under the SAFE Act, I'm going to take responsibility for what they do and I'm going to be accountable, how could that possibly gel with the test that the IRS requires to be an independent contractor? Like, you can't do both. They're just totally incompatible inherently. So I don't know how you can and the problem is it's kind of a rock and a hard place. If you get hit, then your defense is to say, no, sorry, I violated another rule. Not the best scenario to be in. So the answer, and look, I understand that certain banking departments of certain states have said it's okay from our perspective to be 1099. That's their perspective. That's not the IRS perspective. It's not the perspective of FHA. It's not the perspective of the CFPB or anybody else enforcing RESPA. It's just their statutory, that it's okay with them. But it doesn't mean it satisfies every other rule. It's really unfortunate, but it's out there. Now, when lenders are brokering loans, one thing that comes up is, when can they be paid differently, in brokering versus lending? And the answer is yes, okay, with one kind of exception. Well, not exception, but yes, when there are no available alternatives to the borrower. This really goes back to that proxy analysis, right? This is what it is, because whether you're paying the loan officer, broker versus banked is not a term of a loan. Like, in and of itself, that's not a term, right? The question is, does it correlate to? Well, it may, but here's the other thing, and that's why it could be a proxy, right? But what if the loan officer couldn't steer? So let me give you an example. Person wants to do a non-warrantable condominium, or a condominium that's not FHA insured, right? You're as a lender, you have no product you can give them. Or they have a 580 credit score and you have no products for someone who's 580. Like, you're just done, right? You say, I'm sorry, I can't help you. So when you're in I'm sorry, there's nothing I can offer you situation, but there's a broker product. Could you give them that option and pay differently on it? The answer is yes. Reason being, there was no option to give that borrower. Now, I want to distinguish that from a scenario where it's not the option the borrower wants. So, for example, borrower comes in and says, I want to do a 10-year fixed, and all you have is a 30-year fixed. And you could get them to do the 30-year fixed and bank it, or give them the 10-year fixed brokered. You can't pay differently there. Reason being that you had the ability, you may or may not have been successful at it, but you had the ability theoretically to steer that borrower between the 10 and the 30. In that case, because you could have done that, and it would correlate likely to a term of the loan, then it would be a proxy to pay differently. So as long as you're dealing with a lender in a lender capacity, as long as you're dealing with a scenario where there's simply no alternative to give this borrower, none, not the one they want, but no alternative whatsoever. So there's no way to steer. You can pay differently between brokered and banked loans. So let's talk about some other acceptable distinctions I've seen. I'm not going to go through every one of them. I'm just going to go through ones that people have, again, expressed surprise at. Purchase versus refi. Can you pay differently? Well, a purchase is not a term, nor is a refinance a term. Is it a proxy? Well, it certainly correlates to terms. Here's the problem. Can you control whether it's a purchase or a refi? Can a loan officer steer that? Of course not. No one can make a refinance a purchase or vice versa. So it's not a proxy, so you can pay differently. How about new purchase construction? You're buying a lot and putting a house on it. Can't really steer that one either, right? So you probably could pay differently on that. Now, I think if you're talking about some kind of renovation loans of an existing property you hold in a refinance, that might be a little different. How about state location of the property? Listen, if a property's in Michigan or Florida, you can't change that, right? It may correlate to terms, but there's no way a loan officer can make a Florida property a Georgia property. It just can't be done, right? So again, you can pay differently because again, could not be something they steer. How about the difference between self-sourced and company lead? Can you do that too? Not a term. Probably, and here's the thing, is it a proxy for a term? This is where people are starting to get in trouble. They're saying, oh, well, we're just going to call it this or call it that. But here's the thing. Could you steer? And if you have a kind of a looser system that's not demonstrable, yeah, clearly you could just put it in one column or the other. So the answer is yes. And would it correlate? Well, if it correlates, then you could have proxy for loan terms. And you're seeing certain lenders using it clearly as a proxy. It's happened. I'm sure you guys all know because I've had some of you guys complain to me and say, hey, but XYZ is doing this, right? You can't. It's clearly a violation. So, what I would say, and by the way, regulators are onto this. If states of Washington, Minnesota are asking about it, there's also been a number of employee lawsuits filed because they're coming out and saying, wait a second, I had this contract that said I was going to be paid, 100 basis points if it was self-generated, and I got 50 and it was self-generated. And then, it's your word against theirs. And there's the whole regulatory violation because they're saying, well, I was told to put it here so I could close the loan. That's not a fun one to litigate against, especially if they get some other employees with them. That can be a real problem for a lender. And then, one other thing is and this is just an example, let's say you had one loan that the loan officer did the whole loan on and another loan where because they're busy, you assigned a loan officer assistant to assist them with the loan. Again, this has to be documented correctly. It can't be proxy stuff. It can't be a sham. But if there was legitimately, you could show this is what an LOA did, and we assigned them in these files, and they worked on these loans, and so they didn't do as much work. Something like that could be a legitimate basis for distinction based on the amount of work done. But you're going to have to document that really clearly between the two situations, right? If it's, for example, an LOA on every, and you switch the LOA, then no, you couldn't pay differently for that because that would be a proxy and clearly something you could steer. So just, but I wanted to just point that out as some of the other ideas out there. There are other distinctions. This is not intended to be, complete list of them, just some that I've asked about lately. How about managers? So I've gotten a lot of questions also lately about managers. The fact of the matter is, if they are not, and here's the key word, people say to me, oh, well, they're not producing. That's not the question. The question is, are they originating? Because there's a difference, right? When you're talking about originating, the question is, are you obtaining information from a borrower about potential loan scenarios or providing information about potential loan scenarios unique to those borrowers? So, for example, having something that says, our loans are 3.5% interest rate. No, because that's nothing unique, specific to the borrower. Change it around. Oh, we could do a loan for you because, even though you had a foreclosure a couple of years ago, we've got some products for you. Right now you're talking about something that is unique from the borrower that you're starting to give them information on. The other thing is holding yourself out to the public as such, right? So if you've got a big sign out there that says, hey, call me, I can originate your loan, you're an originator even if you aren't. So remember that with managers, because if you get that piece wrong, it's usually pretty easy to prove and lots of bad things can happen. So, really the only time I think you could pay a manager on profitability, my rule is sort of like first you have a contract that says these things, right, that you're not going to do any of these activities. But the other is really think about people who are just out there, really business development managers. They're going out, they're meeting realtors, they're meeting other referral sources and creating relationships, and that's what they do. They don't talk to borrowers. They're not overseeing loan officers every day and dealing with problems that arise. I think if you're in that world, that's sort of your producing manager. Everybody else, though, I'd be pretty worried about it. When you have loan officers managers who are producing managers, you can be paid also on, this comes shifting gears a little bit here, can they be paid on a P&L? And the answer is yes, a modified P&L, where the P, profit, right, is actually set and fixed for every single loan that comes in. So no matter what the term is, they get 300 basis points less expenses. Fine, you can do that. The other thing is the L, the loss, or I should say the expense side of it, is that it can't be loan level. So it can't be, less whatever appraisal fees you collect, right? Because then or origination fees you collect. Then that's loan specific and you get back to being, to violating the citing the LO comparables. You can pay on volume and you can pay overrides or some combination thereof to producing managers. So now that we've kind of taken some things up, let's go to some important features of comp agreement. These are some of the ones that let's talk about. One of them right up front is classification of loan officers. You really got, and what I'm talking about is FLSA compliance. You've got the main ones you're going to see are inside, outside sales, somebody's in a managerial role, and some in the highly compensated role. I don't use that one as much because it's a kind of a test where if you don't meet it, you only find out too late, and then you've either blown it and you got to make up for it, or you got risk. So I don't love that one. But I'm leaving it out there. And here's the thing: don't mix them. Okay, some things go really well together. Peanut butter and jelly. But salmon and I don't know. Name something that wouldn't go well with it. There's probably a lot of things, right? Ice cream. Okay, salmon and ice cream don't go well together. That's the same thing. I mean, the reason you cannot mix these, and I've seen people try to do it and say, "Oh, well, we're going to meet both tests." You can't. They're inherently inconsistent. An outside loan officer, okay, is someone who, think about it, they're out and about, they're doing their thing. The reason you're not paying them for hours is because you can't really track hours, and they're kind of always working, and they're paid on commission only, and so you really can't control when they come and go, and so that's outside. But as soon as you say, well, you're only going to work 40 hours a week, and you're going to pay overtime, and hold on, if the point was you couldn't really track them, then why are you doing that? And what happens is you can end up with a scenario where they kind of undermine each other a little bit. So I'm very against people kind of mixing those two ideas. Particularly, I think what also happens sometimes, and this is just a practical advice I've seen, like let's just say you could possibly do that, and I don't think they're necessarily. I mean, I don't think it's the best course of action, right? But what I've also seen is that internally, you have your conversations with the lawyer and you do what you're going to do, but invariably 2 or 3 years later, somebody in HR is doing something and you've considered them outside sales, but you're going to pay them on a 40-hour week, okay? And then somebody in HR, unbeknownst to everybody else, puts on the system classification non-exempt. And you haven't exactly, and that happens, and then the wheels come off the bus, right? So you want to be really careful about doing this. I mean, I think don't try to sort of play it one way or play it both ways. Pick your best argument. Go there. Make the argument, make the position, and do what's going to fit the people. Not trying to do a one size fits all by throwing this kind of conglomeration together. Keep them separate. It's better to keep them separate. I've told people this a bunch of times, and somehow they still think somehow it's better, or they're scared about outside sales because they feel like, well, it's going to be so hard to prove it. Well, then let's just take that part of the analysis and decide. But I will tell you this, I think there are some ways to ensure that outside sales exemptions, Matt. I don't want to go too far down that because it's kind of getting separate from the point of this, but just be aware the important thing here is that you want these agreements to be able to support one of these exemptions, and you really have to look at the duties, the obligations of the jobs, and the compensation to make sure they work. Clawbacks, can you do those? Now, here's the thing. You can't really claw back compensation once it's earned. There's a lot of state labor laws that prevent that. Also, HUD could have some issues with it depending on the situation. So the key is that, and we're going to get to this in a minute about when is something earned. So if you want to have a clawback that's part of the compensation formula, right? Not the difference is this: X plus Y. If you sell this loan, you make $100. Done. Period. End of story. And then you say later, but we're going to claw back from the money you made if this happened. Can't do that. What you could do is say, you make $100 per loan less X, and that's your commission. So part of the commission formula, okay. Not part of it, not okay. Severance is another issue that comes up a lot. This is another mistake I see common in agreements that people make. They say, oh, we're going to pay you. Well, here's the thing. You don't want to say that, right? Because it's contractual. And let's say that people, they run off with, half of your employees and take files and do all these horrible, nefarious things. And the client comes to me and goes, well, I'm not paying them. You got to pay them. Why? Because you have a contract. And it didn't say if you do bad things, you're not going to get paid. It just said, we're going to pay you. You can sue them for this later, but you can't engage in self-help, because then you're violating labor laws of the state for which there's penalties for non-payment, and you get into that whole mess. So make sure any severance is conditioned on some type of minimal behavior. The other thing is make it simple. I've also seen people go to the extreme and have 5 pages of for cause. Look, we're talking about, make it reasonable for the contract and what's at stake. Usually you're talking about, not tons of money on the loans that close after they leave. Restrictive covenants. This is another big one. I mean, what are you going to use to protect yourself? Okay. So which type of restrictions are you going to have in there? That's obviously something that you're going to want to make sure is in there. And it really has to be determined for each state. The key thing I would say to people when you're drafting these is to look at it from the perspective of what do I absolutely need, not what do I want. If these are drafted too broadly, they're useless. And when the courts read them, they read them not as you meant them, they read them as you write them. So let's say, you're a company and you wrote an agreement, and let's say you're only located in the state of Florida, and you write an agreement that applies to the entire United States. It's going to be struck. And you could say, well, I only meant it for Florida. It doesn't matter. It's not what you said. You're done. And you get nothing. You're just done, right? Some states blue line, we won't get into that right now. But the point being, you want to really draft these to be enforceable, that are going to be the minimalist necessary to give you the protection you need. When you go too broad and you ask for everything you want under the sun, you're going to end up with nothing, right? What's the old saying? You can be a horse, you can be a cow, but you can't be a pig. You got to think that way when you're doing these. And a couple other things in here were just arbitration agreements, okay, that I wanted to cover. Arbitration agreements, a really important key feature of arbitration agreements is that you want to have a couple things. First of all, I would use JAMS. I think that's a better source. They have certain rules that are better for employers than AAA. AAA has a rule that basically says, and you understand why they do it, in any kind of employment dispute, the employer pays, period. JAMS says that if the if the employee selects arbitration, has a choice, then they may have to share the costs. That's pretty big, because it's a way of just incentivizing people to file claims and just make you pay for them. The other thing is that I would give loan officers per that kind of the choice of signing on to a clause for arbitration that allows them to either reject that one clause in the contract or accept. And the reason I say that is because a couple things. First, if you're signing on to an arbitration clause and you don't execute it, and you can't bring a lawsuit and bring all the other people who signed an arbitration clause on. They're covered by that arbitration clause they signed. So one odd person can't undermine the clause. They still might be isolated. The other thing is that, the number of loan officers who will typically opt out of these types of clauses is in the lowest percentiles, because often, if you write it the right way, it's just not going to be something they're going to focus on as much, and they'll forget about it. So if you have a clause that says, if you don't want this, sign here and or, send us a note in 30 days, that kind of language, no one ever does it. They just forget about it. So that's another piece. And then, the last part of, like, obviously with these agreements is you want to make sure there's some language in some states that have really focused on jury trials and making sure they understand they lose the right to go to a jury and go to court. You want to make sure that's explicit in these agreements. It's pretty new stuff that's coming out from courts, but it's important. And obviously, when I'm talking about arbitration, I'm talking about arbitration agreements that contain class waivers. So the other thing that is really important with these agreements is defining in the contract when things are earned. What I mean by that is when legally, when something is earned, the term earned has legal significance. It's not just kind of well, did you earn it? It has a specific legal meaning. And what it is that once you determine the commission and they've received this amount of commission money and it's been established by the contract, they've earned that money and it is theirs and it can't be touched by most state laws. You can't deduct from it. You can't withhold, you could do your tax withholdings, health insurance, but other than that, you can't touch it. Think about it this way. Once money is earned, it's like an employee who works at a store and they're short $5 in the cash register. You can't take it out of their pay. Right? You could fire them, right? You could reduce their salary next time, but you can't retroactively say, well, now you owe it to me. That's not allowed virtually in any state. And so when something is earned like commission, it's theirs. So the key is if you want to have a clawback, we mentioned these before, or if you want to, have some types of commission, things happen, so you want to do that before it's earned. So you define when it's earned. One thing I do, and I recommend my clients do, is define earned as loan closed, funded, and after any period for an EPO or EPD has been met. Why? Because if the loan goes EPO or EPD and they've earned it, you can't claw it back. It's theirs. There's no clawbacks then. But if it hasn't been earned by that parent, you still can do it, right? So there's a way to actually recoup that money if that occurs because it hasn't been earned. And again, these things have to be written up carefully by somebody who knows kind of the various state laws and how you've got to term things. But little points like that are very critical to drafting these agreements correctly. And so that's sort of the idea here is just when you draft these agreements, know how you're drafting them, know what you're drafting for. I think we're out of time, so I can't really answer any of the questions, and I appreciate you guys for sending some. There were kind of too many to go through. But if you have any, you can send them to me. I'd be happy to answer questions. You've got my contact information there. And I thank you guys for your time and attention. I hope you guys found this useful. Have a great day.